Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community. I'm Nathan Stovall, and welcome to what marks our 100th episode of the Street Talk podcast. This milestone coincides with a really fluid time for the banking industry, with the Fed tightening aggressively to tame elevated inflation. And that has put pressure on bank liquidity, led stress into the markets where long-term rates are at the highest level we've seen in 15 years, and sparked some concerns over a slowdown. Things remain pretty healthy today, though. And we want to talk about the outlook for bank stocks, the impact of higher rates on deposits and liquidity in the bank group broadly, and how those factors are impacting strategic decisions, including M&A. And thankfully, we have a great guest who can not only cover all those items, but one who's befitting of our 100th episode. Coming back on the show is KBW CEO Tom Michaud. Tom, thanks for coming back.
Nathan, thank you for having me, and congratulations to you on having this be your 100th episode. And I know myself and others are looking forward to listening to many more.
Well, thank you. Well, I wanted to start off talking about bank stocks and just broadly where valuations are. We've seen the group sell off a good bit this year, depending on if you're looking at the big bank index, down almost 20%. The regionals have held up a little bit better. What do you think about current bank stock valuations and kind of what they're telling us about the group broadly? Are they suggesting to you that investors think that higher credit losses are coming, that the benefit of higher rates are waning? What do you think valuations say to us today?
Well, I think what's interesting about this current moment is that there are two worlds. There's the world of what's happening right now, and then there's the world that investors seem to be really worried about. So let's talk about the world that's happening right now. We think we're in the second quarter of a really strong bull run of net interest income growth. We think we're in the second quarter of what'll be roughly double digit and near 20% net interest income growth for the industry. And that's happening for a couple of reasons. One is higher rates is helping. We do have loan growth, even though loan growth is slowing. And we're also coming over or off of a period during COVID where there wasn't a lot of loan growth and things were delayed because of the pandemic. So we're in that catch-up period, right at the moment. So the current environment is going to be accelerating profitability. And this is for a spread lender. I mean, the banking industry is big and broad. We could speak differently about the global SIFIs and the ones with investment banks, and we should spend a moment on that, but they'll have a different experience. But for the core regional banks, really good revenue growth and the return of operating leverage. Pre-COVID, there was no operating leverage in the industry, and it was tough to grow revenues. So that's the here and now. As far as the future goes, the market is nervous about the earnings forecast for the next couple of years. And the reason being is the market's nervous about credit costs, but the market is also nervous about deposits. And what's interesting there is, and this is a great moment for the history books, because when the policy responses were made to COVID, both monetary and fiscal policy, we think the net result of that was $3 trillion of excess deposits found their way to the banking industry. In other words, we think that the deposits in the United States, now it's about $2.9 trillion, but it's $2.9 trillion higher than it would have been if we hadn't had the pandemic and the policy response. So those funds are going to leave the industry. And it's going to be different this time because I don't think we've ever done this before. So investors are nervous about that and how that's going to play out. So, my view, well, we just wrote a piece that in the last year, we've raised our earnings estimates for 2022 and 2023 by 17% for the average bank for both years. Normally, increasing earnings estimates make stocks go up. That hasn't happened because the PE ratio has dropped considerably because investors don't believe the earnings. And they believe there's too much macro uncertainty in the economy. I think the mentality, and I do also speak to a lot of investors, a statement that I feel comfortable with is investors would rather buy the stocks 10% higher with more certainty than buy them now with as much uncertainty. And the uncertainty, like I said, it's the economy, it's credit quality, as well as how this excess deposit leakage out of the system is going to play out.
Mm-hmm. It's almost like the three different ways you put it. They don't believe it, whatever it is, whether it's the current economy that it'll hold, on the credit, that credit is going to remain this pristine, which almost nobody believes it will remain this good, but that maybe we have our arms around it. And then lastly, that those deposits are real. And so that this margin expansion is going to be kind of completely fleeting. And I'd be curious to pick up on the last one, because the comment about surge is well taken, and the amount of cash that's flowing in the system. And we've seen, in Q2, we saw some of those deposits come off slightly. But we haven't really seen much change in terms of deposit costs yet. I mean, it seems like the banks have been willing to say, sure, go find a higher yield. In terms of what the various things you can look at and what they're marketing out there, you're not seeing a big move, at least one that would be commiserate with, call it, the big liquidity fears out there in terms of deposit rates are being marketed. At least I feel like I haven't seen it. What is KBW's sort of expectation for deposit costs? And we always talk about it, I know you do too, in terms of betas. Like what do you think we'll see there this cycle, and maybe compare it to sort of previous cycles? Like, do you think that banks are going to have to really pay up to defend that cash, or will it just be a place where, we'll let it go away and we'll be able to hold the line fairly well?
To give you an idea on deposit betas, we think deposit betas in the second quarter was 6%. We think it'll be 20% in the third quarter. And in the prior cycle, it was 40% over the life of the cycle. We used to think that it was going to be a little bit less this time than the prior cycle, but we now think it'll be like the prior cycle, so 40%. Now, if it's 40% over the life of the cycle, and we just did 6% in the first quarter, that means mathematically it's going to start heating up. The other thing that was unusual about this surge in deposits is the liquidity on the bank balance sheets went from something like 3% is what we would call it, up to like 8%. And so what's happening is that excess liquidity is being used right now. I've seen examples of banks where they've allowed their overall deposits in the second quarter to shrink because they didn't want to chase costly deposits because they had plenty of low-cost deposits. And there have been banks who've been growing their non-interest bearing deposits, but happy to let the more costly deposits go. So they're able to optimize deposits rather than maximize deposits. And I think that's what's going to happen. Is it shouldn't be surprising to anyone that deposits are leaving the industry. What I think the history books are going to do is they're going to go back and they're going to look and see which bank managements were best positioned and managed this transition the best. Another interesting point is that JP Morgan did say publicly that they think in the next 12 months, they could lose $400 billion of deposits as this liquidity leaves, as that's part of the policy. 400 billion would get you about the 10th largest bank in America. So that's not insignificant. And then it'll play out to that degree down the industry. And then there's another angle of this is while these deposits surged and went up $3 trillion, it stressed the tangible capital of the industry because the industry just got levered really fast. Didn't get levered with loans, got levered with securities. And that happened just when interest rates went up a lot. And now we've got this negative mark on all these bond books. So we think a big story of the third quarter and then the fourth quarter will be what's happening to tangible capital. And for the stocks, what's happening to tangible book value. We think the mark to market in the third quarter is going to be very similar to the mark to market in the first quarter, which is pretty notable. So you're not going to have a lot of tangible book value growth for many banks. And I think that's a factor on investors' minds. My own opinion is at some point, Fed policy will steady and then it'll start to correct itself and investors will be more comfortable. I think investors just want to know where it's going to stop. If you look at tangible common equity to assets for the regional banks and the mid cap banks, we are as levered today as we were in 2007. So we were in a position where we had the most capital in that ratio in 80 years, just a couple of years ago. And now we've levered it, and it's levered both because of the numerator and the denominator, tangible capital getting hit a little bit, and then the industry swelling during the COVID. Now, we should also know there's a lot less risk in owning a bond than making a loan. So it'll play itself out over time, but it's also going to play into that competitive element that you mentioned for deposits. It's really how these equations get solved that's going to be important to what the stocks do. My own opinion is if you're a broad-based, broad-funded, typical commercial bank, I think you'll be able to navigate it. And I think that, the profitability for your investors will still be pretty solid. But I'm sure, like in all instances, there'll be some who perform better than average, and there'll be some that perform worse than average.
Sure. On the market piece there, talking about the tangible book hits because of the AOCI mark through unrealized gains and losses. As we've seen those, come up, we've seen bigger and bigger hits. About 5% hit the tangible book value, I think was the median last quarter. You were saying maybe something similar. So again, a pretty big headwind there. From the market side, is it just as simple as that it almost creates a ceiling kind of on the stocks that if tangible book's going down, I'm just not willing to pay X multiple in this environment with all the uncertainty we've been talking about? Is that one of the issues there? Because she said it's not like these guys are really buying really esoteric stuff.
Well, so you've got 2 points there. One is I do believe the industry practices are much more sound than they were in prior cycles. I think by and large, the industry's better managed. And I think that the elements of Dodd-Frank along liquidity and capital actually were the investor's friend. And the majority of those elements were probably good for the industry and the economy. I think there has been good management around that risk. I think that that's one piece of it. I also think that the shadow banking industry has really stood up since the last global financial crisis, and zero interest rates were the rocket fuel for shadow banks. So a lot of the risk, for example, look at leveraged lending. I mean, that's been moved out of the industry, and a lot of that risk lives elsewhere. If you took all of Apollo's credit funds and made it a bank, it would be the 10th largest bank in America. There are some real players out there that aren't banks in the marketplace. So some of the risk is moved away. So that's what I think in terms of the operating for the banks. But you also asked about the investors. I think the investors are just nervous. And while they think the banking industry could do fine, I think they want to see them prove it a little bit. So it's a little bit of a show me situation with the stocks. My gut tells me is some really well managed banks are trading at 7 times earnings with 4% dividend yields, 160 a book. I think that if an investor buys some of those stocks today, in 2 to 3 years, they're going to make a lot of money. But I think these management teams will figure it out, and then the uncertainty will be less. But, if you have a longer term time horizon, you're reluctant to pull the trigger.
Mm-hmm, mm-hmm. Are you seeing sort of two pieces on that liquidity side? One, there's been some talk I've heard from investors concerned that maybe institutions would have to recognize those losses. The banks will say this is an accounting entry. We can move on. But I haven't heard anybody talking about thinking that they're going to need to actually recognize it. And from when I've talked to our attorney friends who deal with regulators, they say they're not hearing anything from the regulators saying that they're going to feel a force there, which would be a good thing, that's not going to happen. But do you get any sense or any feeling that you think that is a real possibility? I mean, I guess it would have to be that somebody be so stretched, even with $3 trillion moving off, even with the JP Morgan scenario you gave, our loan to deposit ratios are still pretty low right now. So to me, that feels like a pretty big, something big would have to happen for that to occur outside of an isolated instance. But I don't know. Have you heard any talk of that, any fear of that?
In talking to experts around the balance sheet management effort here at the firm, we have not seen people being forced to have to sell bonds at a loss to get liquidity. They've got it elsewhere. We're still soaking up the excess liquidity. And so it's kind of like the conversation we just had about deposit betas. We're just not there yet. We're just, the tension in the system is not so great. And that tension could be loan to deposit ratio. It also could be if short-term rates start to go a lot higher than these bond yields that they own. That could be a tension. So, I mean, like there are a lot of different tensions out there that could materialize, but the industry's not there. The industry still has excess liquidity. The industry at the time these deposits were surging did not have a lot of loan demand. They took the money and they either kept it at the Fed or they kept it very short term. And then they started buying bonds as rates went up. I don't think we're there yet, but if you were bearish, you could draw a line out or think of a model that in 4 to 6 quarters gets you to a point where it's more competitive, where we've used a lot of that liquidity. But the good news about that is then we'll have 4 to 6 quarters of amortization of the bond portfolio. So we'll be getting closer to maturity. So the nice thing is this is not like a credit problem where you lose the money, it's gone. My sense is the bonds that these banks buy are pretty high credit quality, and you just got to let them mature, and they're going to earn less money while we get there, unless it levers their capital so much and we get a credit cycle and the regulators say time is up. That's the negative view. And they say, we're going to use today, sometime in the future, to look at things and say, we think you need more capital. Then a bank would be in a position of raising capital at a price they're not happy with. So, I mean, that's the bear scenario, even though I don't think there's any look at the economy that makes you think we're going to get there. And I think banks would have time to see that coming, and they could maneuver ahead of time.
Right. And sure, we might get an isolated instance where somebody had a tremendous amount of their balance sheet in the bond market and maybe had reached further out the curve in doing so. That's likely going to be a one-off in a smaller bank who might not be somebody we spend a lot of time with anyway. But I want to transition sort of on the same topic of liquidity, but whether or not you're seeing any guys look to sort of bolster liquidity now. We've seen the big guys kind of selectively build CDs and maybe even build some broker funding and borrowing small, but you guys have a pretty darn big M&A practice. We've seen a slowdown there as all of this uncertainty out there. Uncertainty is not great for deals. But are you hearing more institutions or hearing institutions at all talk about looking at deals for the oldest reason in the world, buy good deposits? Is that something that you're talking with clients about, whether through whole bank M&A or branch deals?
Well, first of all, I think the sophistication around deposit management is really grown. And I think the fintech effort has really helped. It's amazing what you can do online now and the efficiency that's coming into some of these banks. So, you look at someone like Bank America, who's opening branches in cities and closing branches in suburban and rural areas. And the online capability is really robust. And so I think a lot of these organizations are trying to really become deposit magnets. So I think your point about deposits really mattering, I think that's so true. And I think that the competition for that is getting better, partly because of digital engagement and the role of some of the fintechs. That's on the side of your question about deposits. With regards to M&A is absolutely going to restart. That's been the story since the mid 80s when it started. And we've done an analysis where up to the $1 trillion banks, just about every movement up in asset size results in a higher price to book value. I've almost never seen it as linearly designed as it is today. And scale seems to matter. Now, I can find examples of really good, really highly valued smaller banks and lower valued, underperforming bigger banks. So it's not a rule. But when you look at it on a median basis, it is. It seems to be working at the moment. And so that's an argument for scale. When you're bigger and you have scale, you can focus on, gee whiz, I need more core deposits. I need more, it could be I haven't made the investments in fintech like I need, so I should think of selling for that reason. And I would also never underestimate succession. Consolidation can also strengthen management in one direction or the other. You never know where the most talented managers are going to be. So there are a lot of reasons in favor of consolidation. And I'm also really eager to see how the class of 2021 performs, because there were some, I think, pretty exciting deals that were done to create really strong regional competitors to try to build competitors for the bigger banks. And how these companies perform into the future, I think will be interesting to see. And I'm optimistic on how it's going to play out for many of them. But consolidation is coming. But I'll tell you one thing I'm in the 37th year of my career. One thing that's a good rule is when things are disorderly, you don't get a lot of healthy M&A. If it's really disorderly, you can get recovery or distressed M&A. But when it's disorderly, where you're uncertainty in the economy or uncertainty in the stock prices or volatility in the stock prices, you just tend not to see a lot of M&A. So as soon as things calm down some, my instincts are it would go right back like every other cycle and start again.
Sure. And picking up quickly on talking about creating the bigger regionals, which we had talked about in times past, a lot of those are still pending. We talk about them getting tested. We haven't really got a chance to see them sort of operate as pro forma companies, right? So, I mean, that's kind of taken some of those operators out on the market. But on the last piece, and maybe this is even a good place to kind of close, what do you think needs to be seen sort of for an all clear for things like M&A, but maybe even investors? And could it even be as simple as the Fed says we're done, we got where we need to go, we feel comfortable? Would that be enough, or do you think we have to get 6 to 12 months after that and see that credit hasn't blown up?
It's a good point. I think you raised a good point. So I think it's the two things you mentioned. Number one is, when is the rate of acceleration on the part of the Fed going to come to an end? So, now at this part of our careers, there's a really efficient Fed funds futures market. So like as of this morning, in this interview here in early October, the Fed funds futures were saying that the peak Fed funds rate was going to be around 4.4%. And as we continue to do these lumpy increases, presumably in early November, we'll get another one, we're gaining on it. And so the viewpoint is we're getting closer to the point where the Fed's going to start slowing down the rate increases, and the Fed's going to want to watch and see what's happening. But you need a couple of things to happen along the way. You do need to see inflation break. And so I think you're right. I think number one is investors in the market would like to see, overall stock market would like to get a feel that the Fed's not still on this direct, mission like it is. And then number two, take a deep breath and see how the economy is performing and what that means for credit quality. At some point, investors in bank stocks will feel like the banks are getting a passing grade. And when that happens, it will be an incredible rally when that happens. I don't know when it'll happen, but let me give you some numbers. In the first 2 months of the pandemic, which were in February and March of 2020, there's this subsector of financial services ETFs that we use as a benchmark. It's not all encompassing, but it's a benchmark, and I'm going to give it to you for scale. So in those first 2 months, about $4.8 billion of AUM left the ETFs on financial services. And the down cycle was 2 months. In the first 6 months of the Fed raising rates earlier this year, $18 billion left these funds. So the market was, and this is just a simple measure, the market was 4 times as worried about what the Fed's doing now than it was in the first 2 months of the pandemic with regards to financial stocks. The world we live in, with so much passive investment in ETFs, if suddenly the green light goes on, the valuation of these stocks is so low that I believe that it could be somewhat compelling in terms of buying these stocks. But we're just going to need to get more certainty to get to that point. But there is a big rally ahead of us. I just don't know when it's going to happen.
And as you just outlined, it's almost even pure technical factors.
It is.
That you just go back and that there's an automatic swing that comes with it.
10 years ago, we never would have talked about it. Now, passive investing, and I'd like everybody who's listening to this podcast to think about what their broker or wealth manager tells them. how often are you buying stocks versus ETFs or index funds? And just multiply that by the 300 million people who live in America. That's what's happening.
Well, I think that's a great place for us to leave it. Tom, thank you. We appreciate it.
Nathan, great to be with you, and congratulations again on the 100th episode.